Hello, welcome back. Paul Gerard from Price Accounting Services. This is a bigger video, one of our bigger videos within our series on rental property issues and deductions. This particular segment covers depreciation deductions. When I say depreciation, we're talking decline in value, depreciation, capital works, Division 40, Division 43, all sorts of different ways of describing pretty much the same thing. I'll throw in the word pooling if you've ever heard that one too. So I'm going to walk you through this one. It's going to take a little while, but it's a very valuable, very important deduction with some very uncertain changes that relate to the 2017 budget in May 2017, and we'll discuss that as well. So where do we start? Okay, what is depreciation? Okay, depreciation has many names and it falls under some diverse areas of tax law, but depreciation recognises the decline in value of an asset over a period of time. When we talk about an asset, we're talking about something that has an enduring life, something that can't be just immediately consumed, and it costs more than $300. Now, those sorts of things, if we look around a standard residential property, might include an alarm system, an air conditioner, or split system, pool pump, things like that. So a dishwasher, an oven, cooktop. But it gets broader than that because there are other elements to depreciation, such as the building itself, the framing, the roof tiles, the floors, the kitchen cabinets, all those sorts of things, the shower screens, the windows, all comprise the building. And the building declines in value too. And so we're going to cover that and identify what those really valuable deductions are. So the easiest way to determine these deductions are go and build the property yourself and you'll know what it costs. It's not that easy, is it? Because there's not too many of us who do that. Even if you're tradie and licensed, you're still going to need to engage other people. So most of us go out and we buy an existing property, or we go and buy a new property, and we don't know, we know what the building cost, we know what the land costs, we just paid one amount. We don't know what the bath cost. So it's really important then to ascertain what the value of those and what the items, specific items are. We need to engage a quantity surveyor to do a quantity surveyor assessment of each property. And since 1986, this has been a deduction that's been available, and sadly, not all taxpayers use it. Now, if that's you, go and get one. Ring BMT, Depreciator, or Washington Brown. They're the key firms that we recommend people use. Tell them Paul from Price Accounting Services told me to ring you, and they'll help you. The good thing about these guys, this is what they do for a living. They provide tax advice relating to these deductions to taxpayers who own properties. And all of those firms offer a guarantee that they're not going to charge you to say, well, your property's really not worth anything. They won't charge you. It's, in my view, it's a bit like if you think you've got tonsillitis, you don't just self-medicate or find some solution and think, well, I think I have tonsillitis. You go to see a doctor and the doctor says, you have tonsillitis and here's the prescription and go and get better. So it's the same with depreciation. Go and see the experts, ring them, ask them. They'll happily tell you what the potential benefit is. And it's not uncommon that I find taxpayers who don't have these schedules, they pay maybe $700 or $800 for a report, but it gives them many thousands of dollars of deductions each and every year for many, many years. And that gives them enhanced tax refunds. So it's a win. You will win by doing it. So see the professionals. But what they do, the quantity surveyors will come in and assess your specific property. Sometimes they can rely upon your knowledge and costs. For example, if you're recently renovated, and this is their area of specialty, right? They then break down the cost into several key areas. Assets that are pooled, general plant and equipment assets, and also Division 43, in other words, the cost of the construction of the building. and they'll assess that based on when it was constructed and the dates and all those sorts of things. And they then comprise a schedule which has two methods available. You can either use diminishing value or prime cost. What does that mean? Okay, I'm not going to go into the details because it really isn't relevant. My advice to taxpayers is use diminishing value method unless you're told otherwise. Why? It is an enhanced, accelerated form of the same deduction as prime cost. Prime cost takes, for example, $100 and depreciates it, say, over 10 years. So it's $10, $10, $10, 10 times, okay? Diminishing value weights it heavily at the beginning, and so the amount declines over time. You enhance your initial deductions. $5 today is better than $2 over many years, okay? So that's my tip. Only very rarely have I ever seen a reason not to use diminishing value, and I think it needs tax advice to go that direction. But your report will give you those two options. We'll choose it. Once you choose a method, you're stuck with it, okay? Now, important issue. If you're currently using a tax agent and they've taken your depreciation schedule and put it in your tax return, you have a problem. We never do that. There's a reason why. Your quantity surveyor report is a very technical document that's been prepared using specialised software. And yes, Excel might be behind it, but think of it this way. I mentioned pooling before. Some assets will get to an extent where they fall into the value of an asset capable of going into a pool. The pool has a higher rate of depreciation. The depreciation schedule that you paid for will utilise the most effective method to write off your deduction, your items quickly. If an accountant re-enters that into their software, it will not do that, okay? So here's the problem I see. You've paid quantity surveyor $700 or $800 to give you a report that maximises your deductions. Your accountant has then re-entered it into their system, charged you for their time, and it's going to limit your deductions. Really foolish in my view. It's more practical for me to have a copy of your report on file. We flick to the relevant page, enter, enter, done. That's all we're doing. Now, if you buy additional items after that period of time, there's two approaches to this. You can go back to some quantity surveyors and say, hey, look, I've replaced my oven, can you amend? And they'll graciously do that. Alternatively, as the accountant, you can tell us about the date, the cost, etc., the installed cost for that oven, and we'll manually just add it into a schedule. It's not complex, okay? And our tax checklist has room and space at the bottom of our tax checklist for you to advise those extra items. Okay, so I mentioned things have changed in the May 2017 budget. Let's go through what they are. 9th of May 2017 was the evening of the federal budget, and Scott Morrison announced that there would be a reduction in the ability for property investors to claim depreciation on assets. And at this stage, we have not seen the legislation, okay? But the proposed announcement was this. From budget night, existing owners retain the right to keep the depreciation. So nothing changes, all grandfathered in, it's okay. But if you contract to buy a property after the 9th of May, the only time you can claim the depreciation on plant and equipment items, in other words, the ovens and things like that, is under two situations. One, you acquire a brand new property, or two, you personally have acquired that new oven as the owner. So what it means is, if I go out today and I buy this lovely looking house over here, and I walk in and I can't get a quantity surveyor to assess the value of the oven that's in that property today. So I'm going to lose some deductions compared to how it was a few months ago. How serious is that? Well, I'll argue it's not going to be that serious because that portion of the deductions is fairly limited anyhow. The biggest issue with a property like this is definitely going to be the Division 43 capital allowances, which may well be a deduction of $5,000 or $6,000 a year for 40 years on that property. That's worth far more than the value on specific plant and equipment items. Yes, it's a change. It's a watered down deduction, but it's not probably that serious, and I'm sure your quantity surveyor could give you further information, and I've seen many of them, the depreciators, BMT and Washington Brown, have got articles on their websites that discuss this. And again, we haven't seen the final form of the legislation, we haven't seen it passed, so we'll see what happens, but we do believe that'll get through. So, what else do we need to talk about? Go and get a quantity surveyor report. That's the best advice you could ever get. So until our next session, Paul Gerard over and out.